Hello, everyone, and welcome to another episode of Coffee with Carl. I'm your host, Carl Zoellner. I am one of the attorneys here with Anderson Business Advisors, and today I want to chat with you a little bit about how to get money out of your C corporation. This is one of those questions we get quite often, especially with all the information out there that talks about the double taxation in corporations. So I wanted to talk a little bit about that today and common ways to get money out of there. Of course, there can always be some differences, and we always can want you to consult with your tax professional on which way to get money out of your corporation is best. But it's good to talk about. We don't really think about it. Depends what time, I guess depends what time of year you're watching this video, but could be relevant to you depending on when if you have a fiscal year end or a calendar year end for your corporation on how to get money out. So let's talk about a couple of those different ways. So first of all, when we're talking about corporations, there's two flavors of corporations. There's an S and a C. C is the default, S you have to elect. So through an S corporation, if I'm drawing income through my active business, my S corporation, I can take the money out two basic ways. One is as a distribution, which for simple purposes, it's taking money out, and that money is going to be taxed at your current tax bracket. The other way to take money out is a salary. So you'll pay yourself a salary, which is your tax bracket, plus your self-employment tax, which is at 15.3%. Okay, so those are the two options with the S corporation. The caveat to the salary side, because obviously if we can avoid the 15.3% in tax, we would. But with S corporations that show a profit, generally you're going to be required to pay yourself a reasonable salary given the services you've conducted on behalf of that corporation. So there is some limitations there. However, I will say in my experience, lots of times we're seeing people still take all distributions and no salary from their S corporations. Audit risk. So let's make sure we're taking money out correctly there. From the C corp, and by the way, the S corporation, I know I didn't mention it, but it is a pass-through entity, so it does get the benefit from the 199A or the Tax Cut and Jobs Act. So we can actually, a lot of times you'll get a little bit of a haircut there on the QBI, but that's a subject for another time or a more tax-focused video. Now, the other flavor of corporation is the C corporation. This is the one we always hear has double taxation issues. So it becomes incredibly important to be efficient on how you're taking money out of that corporation so that you're paying the least amount of taxes as possible, as well as hopefully being taxed times on the income that's generated through the corporation. Now, the sort of gold standard of taking money out of your corporation is taking it out as a reimbursement. A reimbursement to me as an employee of my corporation comes out at 0%. And that functions or works because a reimbursement is money due back to me, not money that would function as income. So most commonly, a lot of our clients have spent money out of pocket on education. We set up their corporation as soon as possible so we can capture that education as a startup expense. And now there's a large reimbursement on the corporate books. So say if I spent $50,000 on learning how to, I don't know, invest in real estate or stock trading, if I've captured that expense as a reimbursement on the corporate books, it means, say, that first 50,000 I make, I can reimburse myself. If I make that my first day in real estate or stock, I can reimburse that to myself at 0% tax. And since it was an expense for the business, it is a deduction to the corporation. Yes, the deduction will have to be amortized over time, but it functions as, like I said, I can get that cash back at 0% taxable income, and my corporation can take it as a deduction. So reimbursements are the first way. And there's lots of ways to build up reimbursements in your business. You can have an accountable plan, a 105B plan. We talk about most of these items in pretty much every presentation we do because they're such powerful tools, but they function as reimbursable cash back to you as an employee of the company, as well as a deduction to the corporation. So reimbursements are number one. Number two, is you can pay yourself a dividend from your corporation. Okay, that comes out at long-term capital gains rates, which those tax rates are substantially lower than your short-term capital gains rates, or your active income, which is short-term, plus that 15.3%. And there's another way to take money out. If you loaned money to your corporation or vice versa, you can function in that transaction under a loan from shareholder. So a lot of times it will classify at least some of the money you've invested in your corporation as a loan and pay it back in that regard. And then the final route, or the most or common most final route, is paying yourself a salary. Now, we sort of get scared away from paying ourselves a salary from our corporation, but when our corporation pays an employee a salary, it's a deduction to the corporation, but yes, it is income to us as an individual. So this is where we get that second level of taxation that everybody harps on quite a bit there. I'm not going to spend too much time on that, just that the corporation, if it had taxable income, would be taxed at the corporate level, which is currently 21%. And then if I paid myself a salary, I'd be paying tax on the income from that salary. So when you really run the numbers, it's not that big of a deal. The C corporation has some pretty hefty benefits to it that'll still make it a lot of times the best tool. But I did want to talk about that a little bit because we've been getting a lot of questions on it. So hopefully this is some helpful information for you, or at least will spark a conversation with your tax advisor or business advisor here at Anderson Business Advisors. So for now, that's all the information I have for this Coffee of Carl episode. Sorry it went a little long today, folks, but I think it was a good subject. As always, if you're a client, please feel free to reach out. We're always happy to have conversations with you. And if you're not yet a client, I would encourage you to schedule your free consultation and keep taking advantage of all of our free content we have out there. So until next time, it was a pleasure chatting with you, and we'll catch you on the next episode of Coffee with Carl.